Okay, bang on time. Thanks a lot for that. Let's head straight into the market opening, which is expected to take a knock because of what's happening, across the globe. The first tick on the Nifty coming through with a cut of 130 points, not looking good. The Sensex is down about 500 odd points and the Bank Nifty is down about 400 points. Straight off the back, the advanced decline ratio is at 1:5 in favor of the decline. So the market is clearly quite perturbed with what's happening across the globe and a sell-off coming through. Adani Group stocks are under pressure early this morning. Adani Ports, Enterprises down about 1 to 2 odd percent. BPCL is down about 2%. A lot of these crude sensitives are in focus this morning. Asian Paints is down about 2 odd percent. You have Sun Pharma that's down 1.5%. Tech Mahindra, Hindalco, SBI. So, it's across the board actually. All stocks on the Nifty except three, ONGC, HCL Tech and TCS. Barring these three, all stocks are in the red. TCS, of course, because of that buyback. ONGC because of the way crude is moving. And HCL Tech comes out with numbers this week as well. So do keep an eye out on that. The other couple of stocks that you'd want to look at from the heavyweights, some of these pharma names are under pressure. So Sun Pharma, Apollo Hospitals, etc. are trending in the red. But weak opening for the market. The important bit is now, right? Whether the dip gets bought or whether it accelerates further. Time will tell, but for now we have restricted our cut to less than 150 points.
Well, that's right. Sonia, so the GIFT Nifty was suggesting 40-50 points odd, which wasn't looking very appropriate. But I think 140, 150 points for those that wanted to go ahead and buy the Nifty, well, this would be on their wish list, and you'll have to keep a stop loss of closure around that 30 points odd, maybe 19,470 should be that important level that you should hold out for those that are looking to buy the dip. But stocks in focus. You have Titan that's under some pressure. The stock is down close to 100%. Tata Steel as well is taking a cut of close to 100%. And Abhishek told us that Bank of Baroda's numbers weren't so impressive. So that one as well is opened up with a cut of more than 1%. With regard to Titan and Tata Steel, I think it's more with regard to what's going on with the markets because those numbers were more or less in line. No big disappointment out there. Prestige, the quarterly update looked quite good. The stock opens up with a gain of close to around 2%. MCX, they're given the green signal to move to the new platform. So that's why that stock, after gaining close to around 4% in Friday's trading session, is still up close to around 2%. Order wins, you had Solar Industries that won an order, a large order. So that's opened up well in the green. You have GOCL, they as well won an order. So GOCL as well should come up for you in the screen. And RVNL as well, that's the other one in there that had won an order. So that stock as well opens up well in the green as we speak. Some of these PSU banking names are taking it on the chin. PNB and Union Bank, both of them under some pressure, down between 3 to around 4% odd. OMCs are taking a hit because crude oil prices have spiked up. So you have HPCL that's down close to around 3% odd. In the green, you have Oil India. Crude oil prices moving up. Good for ONGC, good for Oil India. So both of them bucking the trend, up 1.5%.
Well, 140 points is what we have in terms of a cut on the Nifty, just at about 19,500 at this point in time. So, yeah, there's a lot of stuff coming up straight off the bat. IRFC is down about 3.5%. Some of the bigger volume-led losses that are coming through. I think we've got, cuts coming through in, I think, Union Bank we mentioned. But there is other stuff as well. For example, Indigo, if we can have that up, which I think is coming up with a 3.5 odd percent cut, almost, I think, 4% cut at one point. But there is, things are changing around fast, so we'll have to give it some time. But volumes are also picking up. Suzlon is down about 4% or so. Stocks at about, just under 28. That did very well recently. Cochin Shipyard is down about 2.6%. Kalyan Jewellers, I think, saw a very large move on Friday. It's doubled this year, 2.25% lower on Kalyan Jewellers, 252. Ircon is down about 3.5-4%. So some of these railway stocks are coming up with some cuts. Utkarsh, Small Finance Bank, that is down about 3.5%. Again, something that has done well recently, and especially on Friday as well. There is some red on the screen. Market breadth, of course, is skewed in favor of declines. At least that's the way we are starting at this point in time. MCX, as both Nigel and Sonia highlighted, 3.5% up right now. Prestige, you'll be hearing from the management a little later in the program. Stocks up about 2.25%. Supreme Industries is up about 2%. That's just under 4,000 rupees on Supreme Industries. On volumes, HCL Tech is coming up with a 1% gain. Solar Industries, there was a large order win, 2% higher on that one. There is Fortis, which is coming up with about a 1% odd gain as well. Maybe look at Keynes Technologies as well, which is up 3%. So yeah, I mean, there is some 300 stocks which are higher as opposed to almost 1,700 stocks which are lower. Sonia.
By the way, I just want to make one mention on TCS because the stock has hit a fresh 52-week high today ahead of the buyback, right? And of course, a buyback is a positive signal, but Morgan Stanley has put out a very interesting note where they say that out of 15 times, about 10 to 11 times the stock performances getting into the buyback is much better than the performance post the announcement. So, you don't want to chase it from here on because history has taught us that post the announcement of the buyback, the stock actually comes under some pressure. I mean, the last 3 times the buyback was done, there was a fall of anywhere about 1 to about 5% post the buyback. So maybe a lot of the news could have been in the price.
Absolutely. Well, keep an eye out on that one. 0.5% higher for now. Our market master of the day is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good morning. Great to have you with us here on the program. Thanks very much for your time. Nilesh, you guys were at Kotak have been the first to kind of sound the alarm bells for, the broader markets. And I think so many sort of, at least on the sell side and even on the buy side, have followed since. Almost a bit of a consensus view now that this is the time now, at least for the rest of the year, for large caps. We had Pankaj Tibrewal with us on Friday, and he was making this point that the median stock return for mid-cap and small-cap stocks in the month of September actually turned negative for the first time after a long while. Do you hold on to that kind of line of thinking, Nilesh, that there is more to go here, in terms of either time correction or price correction for that part of the market?
Undoubtedly, yes, Prashant. Today, small and mid caps are expecting 10 out of 10, in terms of performance. And there are dark clouds gathering on horizon. Oil prices are likely to head higher after what happened in Middle East. US interest rates are likely to remain higher for longer. And rural recovery could get impacted because of uneven distribution of monsoon. All these things would not have mattered much if markets were not expecting 10 out of 10 in terms of performance. Obviously, at this point of time, we believe there is more margin of safety in large and larger mid-cap and less margin of safety in smaller mid-caps, small caps and micro caps and mini caps. Normally, the valuation should decline as we move lower on the market cap curve. Unfortunately, at this point of time, many of the smaller companies are trading at a higher valuation than larger companies, which is unlikely to sustain for long. The good part is that earnings are also growing at 1.25% a month. So there could be combination of both time and price correction than just price correction.
Nilesh, hi, good morning, and thank you for being on the channel. It's very unfortunate to see the humanitarian crisis that's unfolding in Israel at the moment. But history has taught us that every geopolitical crisis has been one of the best buying opportunities for retail investors. Should one buy the dip this time around as well if things escalate further?
Undoubtedly, Sonia, India is a longer-term growth story. And our earnings, at least for the foreseeable future, are expected to grow anywhere between 1% a month to 1.5% a month. That's growth rate of anywhere between 12 to 18%, depending upon what kind of portfolio you have picked up. As long as this earnings growth trajectory continues to remain, I think every correction is an opportunity to buy. Apart from earnings growth, we also have to focus on 2 things. One, governance standard. Today, Indian governance standards are more comparable to Western world and far better than emerging market peers. We get premium valuation because our governance standards are at a premium. And third thing which we should market to the world is our green commitment. Many of our emerging market peers are not part of COP26 declaration. Many of the developed markets are not on its way to achieve COP26 commitment. India is one of the few countries in the world which will achieve its COP26 commitment, and we continue to remain the lowest per capita carbon emitter in the world. This 3G of growth, governance, and green is something which will keep investors focused on India, and hence every correction is a great opportunity to buy.
Hi, Nilesh. Good morning. you termed the RBI policy at a couple-day kind of policy. They're watching the pitch, they said, and it's turning. They'll play every ball on merit. Tell us more about that. What was your reading of the RBI governor's speech on Friday? And, some part of the street was hoping that we'll see rate cuts. But that's likely to have got pushed back a little bit. Give me your comment on that.
So Nigel, Kapil Dev could ball, bat, field, and also captain.
Yeah.
The RBI is also like Kapil Dev, managing rupee, inflation, GDP growth, financial sector stability, and most importantly, government's borrowing program. And hence I compared that this policy is like Kapil Dev policy, tackling everything. They are keeping everything in equilibrium. Now, market was expecting some sort of guidance on how foreign portfolio investors' demand on debt side will be absorbed. We expect about 20 billion plus passive flows and 10 billion plus active flows. That kind of money is going to have an impact on Indian bond market, and markets were looking forward to RBI's guidance on the same. On the other hand, RBI announced open market operations to take away liquidity. And liquidity was turning negative on some days because of GST tax outflows. So this was a bit of a shock to the market, and hence yields have hardened a little bit. But overall, RBI has done a fantastic job in managing conflicting objectives from growth, inflation, rupee, government's borrowing program, and financial sector stability in control. And no wonder RBI governor got the recognition as the best central banker of the world.
Nilesh, just absolutely well taken, those points. We saw a very large move in bond yields on the 10-year on Friday, almost a 13-14 basis point jump in the India 10-year. And this morning, yields are flat, which means that they're holding on to those levels, about 7.34 or so. Any thoughts on this, and any implications for financials, NBFCs, etc.?
So I do know that in the second half of 24 and first half of 25, yields will come down from whatever level they are today, because one, foreign portfolio investor buying will emerge of about $30 billion plus, and there will be rate cuts by US Fed somewhere in middle of 24. It's the journey from here till middle of 24, which is likely to be choppy, and with little bit of upward bias because of Fed's option of keeping one more rate hike. Now, this will have impact on all those NBFCs and banks which does not have liability mobilization. Any bank which has access to CASA balance and deposit mobilization at a cheaper rate will do well. Any bank or NBFC which does not have access to cheaper cost of funding, they will be in trouble. And we have already seen banks and NBFCs whose deposit mobilization is not strong. They are not participating in this rally. PSU banks by and large have access to rural hinterland, and that has given them tremendous deposit mobilization capability, and that is already reflected into their prices.
All right. By the way, the sell-off has accelerated, so it's getting worse now. The Nifty has given up on that 19,500 mark. The Sensex is down over 500 points. So the market has been trading lower since the start, and it's only getting worse as we speak. Nilesh, I wanted your thoughts on IT, because that's the big thing to watch out for. The earnings season kicks off this week with TCS on Wednesday. The narrative is that things are going to improve, and they have improved, right? The worst perhaps is behind us, and that is the kind of commentary that people are expecting. If you just go by what stock prices are doing, what is your own estimate this time around?
So my feeling is that in terms of results, there will be case-specific stories, but overall general disappointment. We haven't seen sales conversion cycle happening at a faster pace. There is some positivity on cost as work from home has moved to office environment, and the bargaining power of employees have come down as recruitment has virtually stopped. I believe over the last 2 quarters, there's no net addition to IT workforce, and hence bargaining power of employees have come down. So there is less of a cost pressure, but there is a pressure in terms of volume and in terms of sales cycle. I think market has discounted that the September quarterly results will not be as attractive. everyone will be interested in knowing what is the future. And this is where we believe companies which will be able to lay a roadmap that by using machine learning and artificial intelligence, they are able to provide cheaper, faster, better solutions to their customers. They will start getting differentiated vis-a-vis other peers. Every IT company is into AI and ML, but they have to prove that they are better than the peers. If companies are able to convince markets on one, sales volume growth, and second, their ability to leverage AI, ML to create faster, cheaper, better solutions for customers, those IT stocks will be outperformed.
Nilesh, a viewer / I'm assuming a Kotak unit holder messaged me saying that Kotak has introduced something called a new initiative, a digital card yesterday. And you wanted to know more about it. I mean, briefly, could you explain?
So it's not Kotak Mutual Fund initiative. It's the initiative of professionals in the industry. Deepak Mundra has been leading it, but myself, Navneet Munot, Anil Singhvi and Sailesh Lodha have come together as a mentor. Essentially, we are trying to protect environment in a very, very small way. We are replacing business cards with a digital card. There is an app called Save Tree VC available on Apple and Android. Anyone can download it for free. It will take care of your business cards. Na card lenge, na card lene denge.
That's wonderful. And congratulations for that initiative. I'll try that out. And so will all of us here at CNBC-TV18. Thank you very much, Nilesh, for that. Appreciate it. Najib.
All right. Well, just a quick word on the markets. Then, the Nifty went down to around that 19,480 approximately. And we have bounced off that level. So we're at around 19,530. Remember, the gash was far deeper than what the GIFT Nifty suggested. But as we suggested earlier today, the highest open interest is at around 19,500 put. The premium at the start of today was close to around 35 rupees. That's more than double. But that's going to be an important mark. 19,450, 19,470, crucial support zone for the day. So just keep an eye out on that mark. We have bounced 50 points from the day's low. Let's move on then. Hotel stocks. Well, they're in focus in light of the Cricket World Cup, which is being played in 10 stadiums around the country till November 19th. To discuss the demand trends as well as the occupancy trends, Mr. Puneet Chhatwal, the Managing Director and Chief Executive Officer at Indian Hotels, joins us on the show. Good morning, Mr. Chhatwal. Always good to have you on the show. Well, since we're talking about the World Cup, could you give us a sense what proportion of your overall keys gets benefited from this G20 as well as the World Cup, a proportion of your total number of keys?
Well, Nigel, good morning. I think there is a big benefit in all the cities that the World Cup is being played, especially on the dates when you have important matches, or let's put it this way, when you have favorite teams playing out there. There is a big increase in occupancy and in rates. But having said that, I think the sector per se is very well positioned in the short, medium, and long term to experience this upcycle that we started a year and a half ago and keep that momentum going. Maybe it's because of World Cup, maybe because of G20, but more importantly, a variety of reasons, which I'm happy to discuss with you.
Sure. Please go ahead, Puneet. What are those reasons? And if you can tell us, what is the monetary implications for, say, a company like yours?
Sonia, let's first talk about the sector. I think the short-term benefit is coming through demand, which is outpacing supply. Not much supply got added during the COVID time. The demand has come back. And I think the demand outpacing the supply will make the sector perform well. On the medium to long term, the investments in the infrastructure, as we all witnessed, the Bharat Mandapam in Pragati Maidan, and now the convention center in Dwarka, or be it the Geo Center in Mumbai, all this is creating new sources of demand that were non-existent before, because we had no possibility to host up to 5,000-6,000 people in a single room in India. So I think going forward on the medium term, the infrastructure investment in convention centers, the infrastructure investments in the new airports, the infrastructure investments in the new highways creates a very good base for the hotel sector to benefit. And on the long term, one of the key a catalyst for improving rates and occupancies in this sector is the GDP growth. And the GDP growth is expected to be stable, which means higher per capita,
Puneet?
which means higher discretionary spend.
Sure. That overarching theme is, I think, well documented. I just want to understand if you can tell us what are the exact rates that you're getting this quarter, and if you can compare it to the average of, say, the last 3 to 4 quarters, just trying to understand the scale at which, the rates have gone up.
There is a double-digit growth that we have reported in Q1. And talking to our colleagues within the Hotel Association of India, within the CII, National Committee on Tourism, the rates and the general revenue trends is definitely with a double-digit increase. With the wedding season and the Saya dates, coming around the corner, the festival season, coupled with the World Cup, we see no reason why this trend that we witnessed in the last year should not continue in this year. There is nothing that makes us believe, including business on the books, that we share within our fraternity.
Puneet, hi, good morning. Prashant here. That point about the convention center, etc., is absolutely well taken. Anecdotally, I have a friend who's in the pest management business, and there's a World Pest Control Conference which happens. I was surprised when I first heard about it. It's happening in India, I think next year for the first time, and it's happening here in Mumbai. My friend was telling me that thousands of people are going to come, and now that we have this, for example, as you mentioned, the Geo Convention Center, it's possible to host these things. The irony is that the place was booked out, so they're doing it in Mumbai but somewhere else. But point taken, and I think it sort of bodes well for occupancies, ARRs, etc. But is that a big one? Because Mumbai also is a high sort of room rent market, right? For you, is it a structural kind of positive which will kind of added a couple of basis points every year as compared to when this was not there earlier?
Yes, Prashant, very right. Mumbai is the most important market for the hotel sector in India because it is the commercial capital. Now, with the support that we are getting from this one-off events, which will be, a lot of them will be India's first, industry first, being hosted in India over the next several years. I think that the hotel sector is very well positioned to benefit from that. And as Sonia asked in terms of rates and occupancies, of course, we are coming from a very low base. So experiencing 10, 12, 15, 17% increase is still at a very low level, is sub $200 in luxury sector. So I think on an average, I'm not saying for Mumbai, so I think there is still room for growth, and we will witness that growth in the next quarters and years to come.
Puneet, I just wanted you to clarify on this. Some of the stadium visuals we got, they were indicating the stadiums are not very, very full. It's a little bit worrying, right? And there's a big debate going on online as well. With regard to hotels, you're chock-a-block in most of those areas which are hosting matches?
Nigel, it's a very interesting question. First time when I saw that on the opening match, even I got a bit worried. But, it's not with the occupancy rates just of the stadium. It's all the people who come with the teams, the whole entourage, and all the other activities which happen with the press and the post-match parties and events. I think all that together boosts the rates and boosts the occupancies. And as and when we progress further into the middle of this month, let's say 19th of October till 19th of November, as you said in your opening comment, the momentum will keep going up.
I think that has been, it's all over the internet, right? That the stadium was absolutely, was largely empty in Chennai. So these questions are pertinent as to where are the seats going and where are the tickets going, and what's happening.
Look at it yesterday, it wasn't empty. It all depends on which match, which stadium, which date. And I think as much as the first day was like a bit of a shock, yesterday was much more than a relief, including India winning.
Absolutely. Okay, let's talk about your own business then. In Q1, your margins saw a bit of a dip, right? As things are opening up, as costs are going up as well, do you think that there could be a little bit of pressure on margins? And what is the ballpark rate that you're looking at in terms of margins?
See, Sonia, we have given a guidance under Avan 2025 of achieving a margin of 33%. We remain very confident that there is no deviation, there is no dip. But when you come out of a once-in-a-life black swan event like a COVID-19, then a quarter one of this year versus quarter one of last year, we should not look at just the percentage in isolation, and that also very few basis points. The absolute amounts were more than what we expected on the top line, on the EBITDA, and including on the profit after tax. So we remain very confident that we have to support our new businesses like Cumin, like Ama, like our reimagined Ginger, and we need to keep making investments and without losing sight on margins. So margins will stay very healthy, will be in line with what we have guided to the market, and we are very focused on giving the required tailwind that the new businesses need, and at the same time keep in line with the profitability and with the guidance that we have provided during our Capital Market Day and to all the investor community.
Puneet, I just want to clarify, for this India-Pakistan game, those rates that we're getting, I'm reading a couple of reports you'll have to watch the lobbies. I think a lot of people will be spending a lot of time out there going by the room rates. 85,000 rupees per room? Is that the average number that we're hearing? So tell us more.
I think we should not look at a one-off event. We were also all looking at G20, but people tend to forget that the hotels were shut for normal public to go into the restaurants for security reasons. And a day before the arrival and a day after the arrival, the security levels were very tight. So your occupancy drops. But we were able to charge 3 to 4 times higher than we would normally charge. So there is that kind of balance which comes in automatic, but all these events are a very, very big help. This is not just the positioning for that 1 or 2 odd days that the game is happening. It's all those pictures that go through the entire world, which helps in the positioning of the tourism sector. It helps in the positioning of the country, and all those people coming from outside into India, if they extend their stay visiting some of our wonderful spiritual destinations or yoga destinations or other historical sites, that is what creates the demand that is needed with very contained supply, but that drives the room rates as well as the performance of the sector.
Puneet, just one last question from my side. The business environment overall is looking pretty solid. You launched the Chambers, I think, a couple of years back, I think in FY21. What's the traction there? I mean, how many members are you adding? What's the total? What's the target? And what's the potential here, according to you?
Prashant, this is a very interesting question. Chambers was launched almost more than 40 years ago, but what we have done is we have taken Chambers to a very different level and made it a global platform. So we opened the Chambers in Dubai, we opened the Chambers in London. Recently, we announced a hotel in Frankfurt, which will also have a Chambers. We are opening the renovated Chambers in Taj Lands End in 7 days' time. And we are launching a brand new Chambers in West End, in Bangalore, in another couple of weeks. So I think the entire Chambers as a private membership club proposition across the globe, our ambition or aspiration is to get to 15, which means adding 3 more, maybe 1 in New York. This is very, very good. This is a very good trend in private membership club. Of course, it is by invitation. It's not that easy to get the Chambers membership for anyone. We have a very very strong selection process for Chambers membership. And yes, at the current level, we have more than 3,000 members. And we expect this to keep growing as we keep adding Chambers in new destinations.
Okay, all right, Puneet, thanks a lot for joining in and giving us a check on how occupancies are shaping up, how room rates are shaping up. And a reality check, actually, if people are paying 85,000 rupees
Wow.
per night for the India-Pakistan match on the 14th, well, some die-hard cricket fans over there. So let's see how that one goes. But thanks a lot, Puneet, for joining in.
Thank you. Thank you for having me.
All right, that's Indian Hotels telling us about what's happening on the ground. But the market is not bad. Like we were saying, the dips are being used as buying opportunities. So the Nifty has recovered from the lows, still down about 100 odd points. But look at that. There is a slight bit of a recovery that we've seen in the last 10, 15 odd minutes. Let's slip into a quick break. The big trigger to watch out for this week is the IT sector that will be reporting Q2 earnings. In our special segment, Quarter Se Quarter Tak, we will talk about that. Also, Kawaljeet Saluja of Kotak Institutional Equities will join in to talk about the IT sector in great detail. Stay tuned. Well, as we were telling you, this is our special segment, Quarter Se Quarter Tak, and the earnings season officially kickstarts this week with IT earnings. TCS is the first one that will come through with their numbers, posting the results on the 11th of October. And then we have Infosys and HCL Tech. Rima is here to tell us what to expect from the large tech names. Rima, over to you.
Thanks so much for that. So the focus is going to be less on the Q2 numbers, but more on signs. Commentary, if the worst of the demand deterioration is behind us, if demand is picking up, there are green shoots, can growth start recovering in H2 of this year, or is it going to be in FY25? Now, IT stocks have seen a pretty smart run-up in Q2. In Q2, the Nifty IT index is up 7.5%. This is in the July to September period, outperforming the Nifty, which has gone up by 1.5%. So this big outperformance has been driven by two key factors. One, strong deal wins, and two, expectations of a growth recovery in FY25. Now, if you have to summarize Q2 is pretty much going to be a continuation of weakness what we had in the prior two quarters. No further deterioration, but no big improvement in outlook. But the highlight is going to be the strong deal wins. So getting to the numbers then, Infosys growth is seen at close to about 1%, which is similar to last quarter. TCS is seen up close to about 0.7%. For Wipro, revenue growth is likely to decline for the third consecutive quarter, but it will still be within the company's guidance. Tech Mahindra is the other IT company which is likely to suffer a quarter-on-quarter drop in their top line. But the highlight of this quarter has been the deal wins. Deal wins have been extremely robust in Q2, particularly large deal wins. So if you remember, Infosys signed a very large deal with Liberty Global. TCS had signed one with JLR. HCL Tech had one with Verizon. According to Kotak, Infosys is likely to report a TCV, total contract value, of $5 to $5.5 billion in the current quarter, which is much higher than their general average of about $2.4 billion. TCS, according to Kotak, could report deal wins worth $12 billion, up 48% year-on-year. But the question is, when it comes to these very large deals, is are they going to be margin dilutive? Now, for Q2, margins are largely likely to be stable. As you can see, there will be a bit of an impact on account of wage hikes here and there. But some of the key factors to watch this time. One, on guidance. Now, Infosys FY24 guidance, both on the top line and on the margins, is likely to be maintained. So 1 to 3.5%, EBIT margin seen between 20 to 22%. For HCL Tech, the expectation is that the top line guidance of 6 to 8% could be maintained, but maybe, just maybe, the company could guide for margins to be at the lower end of their guidance. TCS has said that they will consider a buyback along with their numbers on Wednesday. And for Tech Mahindra, the focus is going to be on the strategy under the new CEO and margin recovery. And finally, on valuations. Now, valuations are largely similar to their 5-year average. They're slightly lower than what they were if you compare it to a 3-year average, because the 3-year average also takes into account the post-COVID boom that we had. Tech Mahindra is the only one of the few IT companies where the valuations are higher than what we had compared to the 3-year average. There you have it, 21% versus 20% on expectations of a turnaround under the CEO. Back to you.
All right, thanks very much for that. Rima, that's a comprehensive kind of snapshot looking at IT companies as we get into the earnings season. Kawaljeet Saluja is Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good to have you with us here. Thank you very much for your time. What's your sense, Kawaljeet? Will IT earnings continue to underwhelm broadly for large caps and mid caps?
The numbers are going to be weak across all companies. The revenue growth would be fairly muted. But as Rima summarized it very well, the focus this quarter is going to be the deal wins, and the numbers are going to be fairly robust. But if you're talking purely about the numbers, nothing much to look forward to in the quarter.
Okay, what about TCS? I'm interested, Kawaljeet, to understand how the stock could move post the buyback, because it's already at a 52-week high, and generally post the buyback is when the stock tends to disappoint a bit. The run-up is largely ahead of the buyback. Is this time going to be different, and how should investors approach it?
I mean, buyback is just an alternative form of dividend distribution. So that's basically a part of the regular cycle. So nothing much really to read into it. TCS has a fairly clear payout policy of 100% of free cash flow, and this buyback just ends up achieving that objective. Yeah. So there's nothing much to read into the buyback. But if you're looking at probably the fundamental performance, then the numbers are going to be muted. But again, the entire focus will be on deal wins, which will be remarkably strong.
All right. Hi, Kawaljeet. Good to see you in. A long while since we chatted, Kawaljeet. I wanted to ask about mid-cap IT companies. Some of these names, given all the risk, talk of slowdown, but they have just been moving in one direction, and some of them are at a big premium in comparison to the large cap names. Your view on mid-cap IT from here on?
I mean, I guess, I struggle with this general clustering of companies, one set of large cap companies, another set of mid cap companies, In large cap companies, you have certain companies that are underperforming, which is the likes of, let's say, Wipro, Tech Mahindra. In mid cap as well, you'll have similar companies underperforming. Now, there are certain leaders in mid caps, there are certain leaders in large caps. What you have to focus on is companies which have the right model, right leadership, and can compound consistently. Companies, which have those attributes will trade at a premium. So let's say Persistent, which has been delivering quite well for some time, should ideally trade at a premium. And LTIMindtree, which has grown at, let's say, 2 to 4 percentage points higher than some of the large companies, does deserve to trade at a premium. And then there are laggards as well within mid caps. So I guess, to not cluster companies just basis, size definition. There are companies which have scalability attributes, and then there are large companies which have challenges. Yeah, so just take every stock, on its own merit.
There were some large deals that Infosys signed in this quarter gone by, right? So I'm just trying to understand what is the expectation from that, and is there any change in the FY24 guidance that the company has given out? I mean, I think the revenue guidance was 1% to 3.5%. Do you expect any tweaking of that?
I mean, not much really. I think they basically retain the guidance. Maybe, if at all they have to do something, they might just take the lower end of the guidance band up a little bit. But FY24, I don't think the large deals will contribute a whole lot to revenues. I think the big contribution of these large deals will come in FY 2025. And, I just see actually that Liberty Global deal is mentioned at £5 billion. My guess is that it's 1.6 billion pounds, about 1.6 billion euros rather than 5 billion euros. So I guess, but when Infosys reports the mega deal wins or the overall deal wins, that number will be remarkably strong at $5.5 to $6 billion, which is our estimate as compared to the last 8-quarter average of $2.4 billion.
Kawaljit, hi. This is just to kind of take a slightly macro-ish view here. US interest rates have gone up about 450 basis points, roughly. This is comparable to what we saw in the 2007-8 period, right? I mean, actually 2006 to 2008 kind of period. Back then, of course, I mean, there was subprime, etc. Something broke. This time, nothing. It seems to be pretty all clear. But if we were to get into some unexpected trouble, with US still being the biggest market, do you expect that? Because a lot of debate whether whether it can be so perfect, the so-called soft landing, that not too hot, not too cold, or do you think it'll be a little bit messier? Your sense?
No, that has been an overarching worry, actually, in the IT services sector over the last 12 to 18 months. And that's something, which keeps you awake in the middle of the night as to what's going to happen, what will the state of macro? Our base case assumption for FY 2025 is, a soft landing, and which is, forms the basis of our forecast. If there are any changes, to the macro, environment, then we'll have to change our estimates accordingly to reflect the new reality. But I think the macro for the time being is a concern here.
Okay, all right. We won't have to wait too long to find out from the managements, right? This week we'll know more. Kawaljit, thanks a lot for stopping by. And as Nigel was saying, seeing you after a very long time, so hopefully we'll get to see you more often on the channel. Thanks a lot for being with us. All right, well, that's the word on the IT space. That's a big trigger to watch out for this week. But the other, positive trigger we've got is from the real estate space. Prestige Estates reported a very good set of Q2 business updates. The pre-sales have more than doubled. Sales volumes are up 50% as well. The average Q2 realizations have gained by 29%. Do note, the company has launched 5 projects in Q2 spanning 13.1 million square feet in both Hyderabad and Bengaluru alone. To discuss demand trends, we have Irfan Razak, the Chairman and Managing Director at Prestige Group, who joins in. Mr. Razak, good morning and thanks a lot for being with us. There is sort of a hyperactivity in the real estate space, especially in these markets like Hyderabad and Bangalore, if you map the last 1 year, right? Just trying to understand, what does this mean in terms of numbers? I mean, you have almost done in the first half of this year what you did in all of FY23. So just trying to understand, what could the run rate be in the second half of the year in terms of pre-sales?
Morning, Sonia. Yes, I think the teams have really worked hard. Bangalore has contributed the maximum during the quarter that's gone by, because we had some 2-3 very good launches, and that added up to the numbers. And I believe that there is opportunity in all the cities that we are working in. It's only a question of what type of product you bring into the market, what is your location, and how you've priced your product. And that gives us the courage to do more. We are pretty bullish on all the cities, including Mumbai, Hyderabad, Chennai, and of course, Bangalore. Bangalore has given us the maximum this quarter. And I think the current quarter will be the quarter of the outstation, including Mumbai, Hyderabad, and Chennai. And I think these 3 cities will give us numbers for the current quarter.
So just to pin you down to some numbers, right? So you did about 7,000 crores of pre-sales in quarter 2. Is that a run rate that you can do in Q3 and Q4? Can you do better than that? And if yes, this target of 20 to 25% growth in pre-sales that you gave out for FY24, would you want to change that in any way?
I think to match the 7,000 again in the current quarter will be pretty tough. It's all a function of the launches that we do. We did 13.1 million, like you rightly said. But I believe that the next 2 quarters also will be good. We have a slew of launches, a lot of good products coming in from different cities. So we should cross whatever guidance we gave in the beginning of the year. And I believe that we should touch the 20K mark. And that'll be another high that we would have achieved during our history.
Just to clarify that number, sir, earlier you were telling us 20-25% growth in pre-sales. But now you're saying just going by the run rate, you should easily get past that. So for FY24, what kind of pre-sales growth are you looking at? What's the revised number?
I think we are looking at around 20K because since we've already done 11,000 plus. So the next 2 quarters, there's a lot of launches that are coming up. And if I get my approvals in place and the RERA number, we should be able to do the 20K, and I'll be disappointed. Yeah.
Okay. Mr. Razak, hi, good morning. Could you tell us, what was... Hi, sir. What was Mumbai's contribution to this particular quarter which has gone by? How was the quarter we are in? How is that panning out? And what's the traction here?
Mumbai gave us 500 plus crores this quarter. And I believe that in the current quarter, Mumbai will give us more because we've got a very big launch called the Ocean Towers, Prestige Ocean Towers and Marine Lines. And we do have the sustenance sales in the projects that we are already under construction. All this will add up, and I think Mumbai should give us some great numbers. Hyderabad, we are launching the Prestige City Hyderabad in this quarter. Hyderabad should give us some good numbers now. And with Hyderabad, Chennai, and Prestige Pallava Gardens in Chennai, I believe these 3 cities should take us through the target that we have in mind for this quarter as well as the following quarter. And we should cross that 20K mark very easily. The teams, of course, are working hard, and that's what matters.
Your projected annuity is expected to double to FY24, right? What will lead to this? And if you can tell us what is the current commercial portfolio size, and over the next, say, 5 years, what will the portfolio size grow to in the commercial space?
So, see, currently we have annuity coming from 3 sources. One is the office, which is pretty straightforward. The other is the retail malls. In the quarter gone by, we opened the Forum Kochi in Kochi, and that has been a hit. We've had great footfalls there, and I believe there will be a lot of revenue that will come from that retail asset. So we'll have 3 retail assets that are going to be trading, and very soon, like you said, by 525, we'll have a couple more. Similarly, in the office space, we are completing the Prestige Alpha Tech in Pune, and that's almost 1 million square feet. And even that has been fully leased out, so that also will add up to our annuity portfolio. So we are working towards that. And whatever we are constructing, we are making sure that it gets either pre-leased or gets leased as soon as it gets ready. And I believe that there is a lot of traction there. And vacancy levels are pretty low. It's pretty under control. There's nothing for us to be concerned about.
Okay, demand is strong. Volumes are good. New launches as well coming about. What about pricing, Mr. Razak? Final question before we let you go. Is demand strong enough to push through further price increases? And give us a rough sense. I believe that pricing in this year is up by more than 20%. Could you give us the number? How much have prices moved up by now? And do you see further scope from here on?
See, if you look at the average realization in the last 2 quarters, it's around the 10,000. It's breached the 10,000 mark. And I believe prices will stabilize here. I don't see prices going up further. Of course, in certain micro markets, depends on whichever product that you are launching, the pricing will be different. But I personally wouldn't want prices to go up too high, too fast. Again, that becomes counterproductive. If I'm able to control my costs, I'm able to control the land input as well as construction input, and able to offer to the customer at a decent number and keep the momentum. That will be our endeavor. Prices have definitely grown much higher than what they were in the last year. And I would probably want them to stabilize here and not go up further. Because, as I said, the traction will be lost and it will be counterproductive. And we are working at some mid-income housing projects also, where we'll probably have a much lower number.
All right. A lot of your clientele would be breathing a sigh of relief on that. You expect prices to consolidate at these levels, but otherwise, broadly, the commentary is very, very positive. Thanks so much for joining in, Mr. Razak, and wishing you all the best for the second half of the year.
Thank you.
By the way,
Thank you.
the markets have seen a big recovery from the day's low. As we suggested earlier, the markets need to hold on to the 19,470. It's bounced close to around 80 points from those lows. So sustaining these levels is very, very important. For the time being, slip into a short break. You come back. Mitesh Thakur will be joining us to tell us his technical trades.
Okay, there is a decent bounce which has come through from the day's low. The markets, I think, recovered, although it's still work in progress, but it's a decent bounce, no doubt about it. The low was 19,480, and we are about 80, 90 points off that level. We're at about 19,569. Mitesh is with us with fresh trades and what he would do now. Mitesh, hi. Good morning.
Morning, Prashant. So I think on the index, we haven't taken a trade yet, despite the fact that there was some panic in the morning and then a good recovery. I think, we have a gap down since yesterday, or rather Friday, and the Friday's low was 19,590. So I think once we start capturing that, maybe you'll look at a trade on the long side. But for the timing, avoid. And on the stock side, oil India is something, which is breaking and making into a fresh high. So that's a buy with a stop at 297. Look for a target of around 320 here. And some selling observed in Adani Group stocks. So I have a sell on Adani Ports. That's a stock which is again broken down with a gap today. So recommending a sell here. keep a stop at about levels of 822 and a target of 770 is what I'm looking at.
All right. Thanks a lot for that. Mitesh, have a good day. Let's shift focus to the commodity markets because that's where a lot of the action is. There's been a big move on crude. There's so much happening with the Israel-Palestine conflict. Manisha is here to give us the latest on all of that. Manisha, what are you tracking today?
Thank you for that, Sonia. Well, I'm keeping an eye on the crude oil prices because we've seen big moves come into this one. Let me remind you that last week we saw crude oil prices decline by 8%. And the first tick or the first trade in the Asian markets today was 5% on the higher side. 4.5% on the higher side has still been holding, but from those kind of levels as well, we've seen some profit taking coming on the higher sides here. Well, the markets are looking at the Palestine and the Israel concerns. There is concerns about escalation of there as well. What the street is looking at is that there are no supply concerns as of now. This is all sentiment that the markets are seeing. So what the street is calling this is a knee-jerk reaction. There is no supply impact really because when you look at Israel, they don't produce oil. They do refine oil, and both the two oil refineries that they have, the total capacity of that is 300,000 barrels per day. We haven't heard anything on that yet. Palestine, on the other side, does not do anything in case of crude oil production or refining for that matter. So on ground, there is no impact on supplies as yet. The markets do believe that as we go ahead, if this concern or the conflict widens, then we could be looking at Iran stepping in. There already are reports on how Iran could be planned in these attacks, could be involved in planning of these attacks. If Iran comes in, if it gets widened, then you could be looking at supply concerns coming in. At this point in time, there is nothing like that. But the markets also do believe that this is not going to get over in a day or two. That is what the report from Citi, Exim Australia, even Vanda Insights told us on CNBC-TV18. If you look at the fundamentals, well, we haven't seen much change on that. The immediate gain in crude prices also came in after the weekend when we saw all of these countries reaffirm their statements that they will taper with the oil output depending on what kind of demand do we look forward on. And that exactly is the thing. When you look at the demand from China continues to be on the weaker side. There's no fundamental change on ground really. And the US gasoline stocks have gained the highest since 2022 in US. Also, when you look at the gasoline demand in US, that is the lowest in at least 4 decades right now for this time of the year. And that would continue to weigh onto the market. Russia also has said that it will allow gasoline exports via ports. So that is almost 50% of that fuel also back into the markets. So when you look at the on-ground fundamental demand and supply, there's no change in that. It is a sentiment move that we have seen come in for the crude oil prices. And this tells you on how the crude has been in this year until now. We started with 82, we went to 70 in the month of June. September saw high at 96, which also is an 11-month highs, by the way. And then we saw a sharp decline. 1st of October opened with 85, and we have seen a turnaround on that yet again. So 88 is trading at this point in time on the screens. So continues to be very, very volatile. Markets do believe that until the end of this year, now you have a wide range, anywhere between 82 on the lower side to 102 on the higher side.
Manisha, thank you very much for that. There's commodities and oil in focus. Well, let's just shift the focus back to stocks once again. MCX, we highlighted that right in the morning. It's up 4%. Sudarshan is here with a spotlight on that stock. Sudarshan, morning.
Good morning. Yes, CNBC-TV18 News Break is confirmed and MCX is buzzing in trade. The regulator SEBI's technical advisory panel has given the green signal for MCX to shift to the new platform. And as for the company, the panel has taken this decision after going through the submission made by MCX in regard to the complaint by Chennai Financial Markets and Accountability, which is known as CFMA, before Madras High Court. CFMA had raised technical issue in the platforms, and that case is now likely to be heard on November 29. As per the disclosure by MCX, it seems SEBI's panel was satisfied by its response, and it has asked the company to submit go-live date of new platform to SEBI. Following this update, SEBI has withdrawn its September 29 order of keeping the shift to new platform in abeyance. Now we need to wait for MCX to announce the go-live date, and just for the reference, I would say MCX has an agreement with 63 months till December 2023, and what I understand from my sources, it would keep that platform till the expiry and use it as a backup till then. Also, as per analysts, there will be major cost saving post the shift to new platform. Currently, company pays rupees 125 crore per quarter, which is almost 100% of sales of a quarter. It's expected to fall to 10 to 12% of the sales after the shifting to the new platform.
Thanks a lot for that. Let's move on. Solar Industries and GOCL Corp are two stocks in focus. Solar Industries actually bagged its biggest ever order. So that is definitely takes center stage. Vivek is here to give us the latest on all of that. Vivek.
Well, absolutely right. It's a large, sizable order. Solar Industries received an order from Coal India, and the value of this particular order is over 1,850 crore. Now, to put this in perspective, the total order book of the company at the end of Q1 FY24 was just around 2,700 crore. And this includes the defense order book of close to 1,050 crore. So, large, sizable order win coming in, and this particular order will be delivered over the next 2 years. Now, what the management told last time is that the annual guidance is 700 crore revenue from defense itself, and currently 155 crore per quarter is what is anticipated, which will go ahead and increase to 175 crores. Now, the other company that we're tracking, GOCL, the company wholly owned subsidiary IDL Explosive, received orders worth over 760 crore from Coal India. Now, this is again for supply of bulk explosive. The company has a order book of over 550 crore.
All right, thanks very much for that, Vivek. So those are two names to focus on with news flow. We'll take a quick commercial break here, but stay with us. We are coming back with the management of Som Distilleries. So we'll ask them the impact of the GST cut on molasses, whether they are impacted and what way was the industry impact. And to discuss some of the other things which came through from the GST Council meeting on Saturday, Rohan Shah, Tax Counsel, will also be with us. Stay tuned.
Well, the GST Council cedes the right to tax extra neutral alcohol to the states. GST on molasses gets slashed to 5% from 28%, while the council also decides to not levy any GST on millet flour containing at least 70% millet composition. However, a 5% GST will be levied on branded millet products. Well, the government has, called 2023 the year of the millet, so hence they've made this decision. J.K. Arora, the chairman at Som Distilleries, and Rohan Shah of the Tax Council joins us now to talk about that. Mr. Arora, good morning, and Rohan, good morning to you too. Let me start with Mr. J.K. Arora. The question to you, sir, is that, you operate on about 40 to 43% gross margin levels. Can you tell us how much of your material cost is ENA from molasses, and the fact that this GST rate has been slashed, right, to 5%, what kind of impact would it have on your own business?
So actually, on the alcohol which we use, there has been a GST department has been disputing and putting the tax on the alcohol which we use, and there has been few high court also have been given a ruling that the GST on the alcohol is a valid. But one thing is very, very clear from the Constitution of India, that manufacturing of liquor, storage, transport, licensing is all within the state domain. So actually, I am clear from the day one that GST cannot impose the tax on the alcohol because it's a state subject. Only thing is they can put the taxes on the industrial use, which has been finally now, after lot of persuasion and lot of litigations, GST Council has clarified that tax on the liquor, on the alcohol used, GST is not applicable. I think this is a good clarification, and lot of litigation will end since they are going to issue the clarification also. So I think this will end lot of litigation.
This had been, Mr. Arora, hi, good morning. This had been being issued by state governments, sir? This was being levied by state governments?
No, GST is the central
yes,
government.
I know.
It's the federal government. Yeah.
But there were some appeals, etc. I think in Uttar Pradesh, for example, there was some...
Andhra.
Correct. So there was some dispute going on, right, at the courts?
Yes. Lot of dispute. The crores of rupees of demands have been issued by the GST department.
So all of that gets resolved. All of that gets resolved now, sir?
Yes. Of course, because it is the clarification is a very, very much. Actually, there was no dispute, but in the anxiety of having the more and more taxes by the GST department, they were actually imposing, I would say, a bit unfairly. But because Constitution is very, very clear, and the Constitution is above all acts, law, high courts, it's above all, it is this thing. So I don't think this thing, but finally, anything, it is cleared by the GST themselves. So it is a nice, I would say, it's a good development for the industry.
Okay, we have Rohan Shah, who is from the Tax Council, who's also been waiting by patiently. There is a GST that has been imposed on corporate guarantees, that 18% level. I just wanted to understand what is your view on that, and how do you think, what would be the way forward now?
Yeah, so the GST on corporate guarantees, I think, has been a contentious issue for the last 6 or 7 years. And there have been a series of demands in relation to those. And the stance of most industries has been that it's nothing but a financial facilitation, typically given by a parent or a holding company. And from that perspective, there's no rendition of service, because the parent or the holding company is really doing this in a way to sort of address cash flows or capital contributions into a subsidiary, which, if they can get that through a corporate guarantee or a bank guarantee, effectively assists them and aids them also. So from that perspective, this has been contentious. The fact that they now clarify that it will be liable, I think, raises the other issue that therefore is this liability only prospective? Because if it is prospective, then all these past demands ought to go. If they say it is clarificatory, then of course these past demands in a way are affirmed. But to my mind, the way in which the change comes in, and at 18%, it's quite clear that this should now be prospective, and whatever is the litigation in which is already embedded in the system should in a manner now go away, because the tax, if at all, can only come from the new date that is notified.
But so will we get a separate kind of clarification to say whether this is clarificatory in nature, as you said, or this is, the earlier demands will stand? I mean, what's the...
Look, given the amount of litigation that there is, I think there will still be some amount of push and pull, but the way in which this is drafted, I would think it is prospective. And yes, they will probably issue a clarification to say that it is prospective and all of the past demands therefore should abate.
On the other issue, which is online money gaming, casinos, etc., that issue is also settled now, Mr. Shah?
Not really. I think those issues, the amounts are what they are now, running into an excess of 1.2 lakhs of demands. And that continues. I think we are seeing even more recent statements from the Revenue Secretary to say that they believe even the intended amendments are only clarificatory.
Correct.
So I think there we are really looking at a full-blown legal battle.
Okay. So this will go to the courts, and the courts will have to take a view. Because
there are already writ petitions filed in a few courts.
Correct. From the tax department's perspective, the issue is settled. I mean, they're saying, well, this is clarificatory, so this was always there. So this is just a reiteration in that sense.
It's a nice way of putting it. It's settled subject to court. So, what that means, ultimately, the court will have the last word.
And so, first, we have listed companies as well, which are where large sort of notices have been sent out to. So, for investors, what does this mean? I mean, long, protracted kind of legal battle at the courts? I mean, a few years at least before we get to any kind of... finally, the issue is decided one way or the other?
Yeah, I think, yes, this is going to only get settled by the courts. There is already a pending matter in Gamescraft, which is in the Supreme Court. And there is a positive order there from the Bangalore High Court, which was in favor of the SSC. That has been stayed by the Supreme Court. I think Supreme Court will hear this on a prioritized basis. So while it will get settled by litigation, I don't think the issue will pend for very long, because I think the Supreme Court will find a suitable date in its calendar to, take up this issue and deal with it.
All right, we'll leave it at that. Thanks a lot for joining in and talking about the GST Council meeting and the implications that it would have. By the way, the market has recovered quite a bit from the lows. We started off with a 150-point cut. Now the cut has restricted itself to about 70-odd points. So we've pulled back from the lows of trade, and lots of individual stocks are seeing buying action. So we'll take it forward on our next show, Chart Busters, that is coming up next. Do stay tuned in.